South Africa's GDP pulled back by 0.1% in the first quarter. This largely driven by declines in the mining, manufacturing and construction industries. Kevin Lings, who's chief economist at Stanlib, joins us with his analysis of the print and what it suggests for growth and moving forward. Kevin, always a pleasure and a good afternoon to you.
Hi, good afternoon. Thanks for the invite.
Well, we were expecting an expansion of 0.1%. We got a contraction of 0.1%. I'm not sure what to make of it, Kevin. What do you think?
Well, I think the expectation was only for growth of 0.1%. So there's not a huge difference between +1 and minus 0.1. Overall, it's telling you that the economy is incredibly weak. We know last year we grew this economy by only 0.6%, obviously massively impacted by electricity outages. And that continued on through most of the first quarter of this year. If you look at the recent scaling back of electricity outages, that really only happened in the final week of March, which was obviously too late to impact the first quarter GDP outcome. So when we look at the decline, if you say what caused the damage, the decline was broad-based. It was across all of our key sectors: mining down, manufacturing down, construction down, some of the transport sectors down. And if you look at where we got saved, if you like, was agriculture. Agriculture coming off a very low base last year. So slightly better, mainly actually, strangely enough, fruit and vegetable production was better. So that helped us. But if I look at the core of the South African economy, it was incredibly weak. Consumer spending weak in the first quarter. So retail sales itself was obviously desperately weak. We had a little bit more in terms of accommodation, which talks to the tourism industry. But overall, nothing to get excited about in any of this data.
I mean, I must ask you that, Kevin, because like you're saying, the weaknesses are broad-based. It's on the expenditure side. It's also, if I look at government consumption, household consumption, all of it really, really painting a rather bleak picture. It does not only set a lower base for the future, but it also tells us that from a practicality perspective, we have a lot of levers we need to pull at the same time to get us going in the direction that we'd like to go.
Yes, so I suppose in a strange way, we've got the advantage of now a low base. So the level of activity is fairly depressed. We know that throughout the second quarter, we haven't had load shedding. That undoubtedly will help. We can already see that in some of the data. So we're expecting that in itself will give us a bit of a boost. The other thing I think is worthwhile mentioning is every time South Africa has an election, we spend quite a lot of money on the election process, either employing people to manage the election or the political parties spending money on advertising and posters, etc. All of that helps a little bit. So I am expecting that you'll see a bit of a rebound in the second quarter when we get that GDP estimate. But it still puts us on track, even with that rebound. It puts us on track for growth this year of only 1%. Now, that's nowhere near enough. And so quite quickly, after we've settled down the politics and the coalition and we kind of know who's in charge, you're going to see an enormous emphasis on, okay, so how do we now lift growth meaningfully? Meaningfully is not 0.6 or 0.7% last year, 1% this year. That's not meaningful. The population grows well over 1% in South Africa. So we've got to look at government and say, what's in place to get the growth rate accelerating to 3%? Is the electricity situation going to remain improved? Are we going to be adding other areas of growth in terms of private-public partnerships? A lot of questions for the government to answer when they finally get settled.
Then we must ask the question of stagflation here, Kevin, because the reason I want to ask this specifically is because also what we are seeing is the fact that there is enough, motivation for higher for longer interest rates. But it's clear the South African economy started to buckle under these high interest rates. Hence, that expenditure side is also so weak.
That's right. So the interest rates undoubtedly add into the difficulties we're facing, especially for consumers, and I would add for small business. Small business in this country is under enormous pressure right now in terms of cash flow and debt levels. So it would be very welcome if we could cut interest rates. I think we're getting closer to that point. The Reserve Bank seems a little bit more comfortable with inflation. I guess it will help us. We're expecting the ECB to cut interest rates this month. I expect the United States Federal Reserve to cut rates a little bit later this year. I think that will help us, takes the pressure off us a little bit. So I'm still expecting our Reserve Bank to cut interest rates twice this year towards the end of the year. I think that starts to help, but clearly it's not in itself a panacea. It's not in itself going to be the revival of South Africa. I think we've got to have a much broader growth initiative that draws in the private sector to the development of South Africa's infrastructure based on sound and consistent policy from government.
I mean, I think that segues right into my final question for you today, Kevin. Of course, we're about to usher in this new administration here. It is important that, private capital wants to invest here in South Africa. But because of the broad-based nature of the contraction we're seeing now, there might have to be other policies that are put in place there. Can we just maybe touch on those as well?
That's right. So you've got. So if you look at it's not just the GDP number. Have a look at a range of other indicators. In particular, look at the confidence indicators, consumer confidence, business confidence, exceptionally weak in this country. If I look at businesses' willingness to undertake fixed investment broadly, that's incredibly weak. So there's a range of indicators that are telling us that the economy is lackluster across a range of factors. That means that if you want to revive the South African economy, you've got to approach it on a broad-based basis. It's not simply a question of keeping the lights on and then it will be fine. There are many other factors that you want to address. And fundamentally, what we've got to do is you've got to lift confidence. People have got to start to believe in the future, especially the business sector, because once that starts to happen, then it becomes self-fulfilling. I would argue at the moment we kind of in a holding pattern. We treading water. We're waiting, and we've been waiting for a lot of things. And just take the electricity outage as an example. People are not yet convinced that it's going to be a lasting benefit. So again, that confidence has to come back. We've got to get the emphasis out there that things are improving, that the government has got sound policy, that the government is focused on the economy, and it moves away from the focus on politics and political negotiation. So I think it's possible. I think by the end of the year, we should have a better feel around South Africa. I'm certainly hoping. But there's a lot of work that has to be done to revive South Africa from this level.
Well, Kevin, always a pleasure having you unpack this data for us. Have a fantastic one further. That was Kevin Lings. He's Chief Economist at Stanlib.